Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. I want to thank everybody for joining us today. My name is Robert Kuhn, President and founder of Kuhn Capital Partners. Yes, we are independent. Yes, we are a fiduciary, an SEC registered fiduciary, and I'm very, very happy that you are joining us. We were thinking about how many episodes have we done, and my best guess is 250. Now, that could be off, okay, but we're going to go with that number. So this is episode 251. So 251. And we're really excited for 2026. And I hope everybody had a fantastic Christmas holiday and really is reevaluating what's going on in the world, what's going on in your finances. And as you know, I am the president of Kuhn Capital Partners. I am the founder of Kuhn Capital Partners. We are headquartered in Oak Brook, but if you are listening to this show outside of the Chicago market, we can definitely work with you. We're very pleased to continue to expand on our geographical locations of where the show runs. So very, very happy with that. A lot coming, because I think the job of a talk show host, an investment talk show host, is not just to sell annuities, which is what almost every other show that you're going to listen to is going to be wrapped up in a financial planning show, market-based show, but yet the answer is always annuities. And we're going to come hard. We're going to hit hard in 2026 because investors listen for my advice. And you may agree with some of it, you may disagree with some of it, but I'm going to continue to give you 30 plus years of just knowledge, and take the knowledge for what it's worth. It's free. So if you don't like it, you don't like it. If you love it, phenomenal. So our job is to be different. We have clearly differentiated ourselves here in the Chicago market, and we're looking to do that in other markets throughout the United States. A couple ways of differentiation. Number one, financial planning based, not only financial planning based, tax reduction based. Probably our greatest strength are strategies that have significant tax reduction built into it. We are not tax professionals, so anytime I talk about tax strategies or legal strategies, it truly is for informational purposes only. It's always best practice to reach out to those professionals. If you don't have them, we certainly do, and we would love to share their names with you as well. We can certainly do that. But our energy strategy in the fourth quarter of last year, it's called Bison Natural Resources, relatively new to individuals here in the Midwest. I believe we have created a private equity fund with private equity risk management, private equity tax reduction, private equity assets, and I can tell you, having vetted, I don't even know how many funds, 100, that there's not a single fund like ours that you're going to find with a minimum of $100,000. And when you can invest $100,000 in the energy space and invest directly alongside as an owner in the projects of the Exxon, Chevrons, Conocos, Matadors, Occidentals of the world, in the number one oil field in the world, Permian Basin in West Texas, we stand alone. And the benefits for you, significant tax reduction. Number one, we think that is free, however. We are much more focused on ROI. We have a 5-year exit target of 100% on your money over 5 years. Relatively, well, I can't really say easy because we don't know what the price of oil is going to do. But if you're buying the deals that we are buying that are generally not marketed, you have a lot of outs before you don't make what I would consider to be over a 5-year period a very, very good rate of return. Most individuals are going to look at the strategy simply because of the tax benefits. Tax benefits, we target an $80,000 to $90,000 offset per $100,000 invested. Again, that's against active, passive W-2 1099 income. So we have a data room. We have done everything institutional, everything third party. It's on the custodial platform of Charles Schwab. Third-party audit. Every one of the funds is audited on an annual basis. Again, it is as clean and as transparent and as institutional as you're going to find. Now, when I reference these names, like Charles Schwab, yes, we went through their due diligence criteria to get on their custodial platform. Do they recommend our fund over another fund? Absolutely, positively not. So you can't utilize the company names that I use on the radio show as a means of endorsement. And if you haven't learned by now, we are incredibly, radically transparent. And most advisors, unfortunately, are not. 630-492-1912, 630-492-1912. Please call and get on our calendar. You'll talk with one of our assistants, and we'll start that process. Very, 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 very excited for what is coming in 2026 for the firm, for our growth. Many of you utilize us and know us as the banknote advisory firm, and we are that. It's so interesting looking at the banknotes. Really quickly, if you don't know what the banknotes are, the banknotes are offered by a major bank. It's a prospectus item, so always best practice to read the prospectus. If you don't believe me, believe what JP Morgan, what Citi, what Bank of America, what Morgan Stanley, what BMO, BNP, Bank of Canada, etc., what those banks are putting in their prospectus. And the beautiful thing about the banknotes is that you can get, we're still getting 12%-ish, so we're still around 12% with 30% downside. So you get monthly cash flow of 12% annualized, so 1% a month if the note was 12%. Could be 11.5, could be 13.5, could be 15, who knows? But whatever the annualized rate is, you get that broken down into monthly payments, as long as the indexes that note tracks are not down 30% from the date it was issued. So every month, it's really simple. From the date we bought it, are the indexes down 30%? If they're not, boom, if the note's paying 12, you get 1% a month. Think about that. So many advisors are doing this traditional 60-40. They're doing the traditional 60-40 because it's good for them. It's good for them to scale their business, and that is not us. If you've walked into our office, we're right off of 22nd Street, right across from the mall. Just Google Fidelity in Oak Brook. We're not part of Fidelity. Fidelity is on the first floor. They're in the same building as we are. We're on the 5th floor, Suite 530. Stop in. We would love to see you. Come and see our massive TV screen in our conference room. And when I say massive, I don't know if you've ever seen a smart board bigger than what we have. But again, we are trying to, well, I can't even say that we're trying to. We are changing the way that investors think about investing. The old school 60-40 models are dead. They're yesterday, they're dead. Individual advisors don't use them for their portfolios. Most professionals don't ever use them for their portfolios. It's just an easy marketing gimmick to get you to think that you can handle any market. The reality is there's a tremendous amount of risk. And so when we see risk in the market, what happens, especially if you're listening to the radio, is the pitch is annuities. So 630-492-1912, 630-492-1912. That is our station. That is our phone number, rather. But that's what you're seeing. You're seeing everybody wrap these radio shows into ultimately an annuity pitch with guaranteed lifetime income. And that's a problem. And we're going to hit it. And we're going to hit it really, really hard this year, because my biggest concern is inflation. My biggest concern is inflation over a 10, 15, 20, 30-year period. And when you compare cash flow and you compare guaranteed lifetime income, those words are phenomenal. Those words are truly marketing words that just bring in a tremendous amount of business. But here's what you need to understand, and here's what you need to understand that you own. You are only taking your own money out of that annuity until the account goes to zero. When the account goes to zero, then you are into the insurance company's pockets. The insurance companies will start to pay you. So this whole 30% bonus, 50% bonus, 8% a year, never. It's on income. It's for income purposes. And so you have to think, what is the insurance company going to do? The insurance company is going to limit how much growth you get, right? And the insurance company is going to meter, put a governor on your withdrawals. Why do they do that? It's a fixed withdrawal. Why do they do that? Because if that account runs out of money, then that money is coming out of their pocket. Actuarially, I think they know that that is just simply not going to happen. So inflation, in my opinion, is going to eat away those lifetime income annuities. And there's such a better way. If you own one, if you're being sold one, if somebody's trying to talk you into one, if you have a friend, a cousin, an uncle that is saying it's the best thing in the world, compare them to the bank notes. Many people, when they do these lifetime income annuities, they're going to wait 5 years, 7 years, 10 years for income. That account is not going to grow much. Now, they're going to show you hypothetical back-tested illustrations that weren't real, and so it's going to look on paper like it's going to grow significantly, but I will show you the real performance because that index is probably only 2 or 3 years old and it's probably negative returns. Now you can't lose money, so maybe the return is zero, but compare that to the bank notes. Compare that to a cash flow strategy offered by the largest banks that is still in the double digits with 30% protection. So we're going to continue to talk about that. We're going to talk a lot about our hedge fund strategy. Now you need to have a net worth to participate in the hedge fund strategy. I believe of 2.1 million, so not including your primary residence, 2.1 million. Now that's not my requirement, but we're going to talk a lot about that. We're going to talk a lot about that today because the idea of margin of safety protects you. And in a way, it also fuels future gains. Most people have zero margin of safety inside of their portfolio. Most people have no idea what the margin of safety is in their portfolio. Most people have no idea if the markets drop 20%, if they drop 30%, what's going to happen to their portfolio. The answer from the advisor is sit and wait. Well, that's not a good enough answer, and we are coming after those clients of those advisors because we can provide more. So 630-492-1912, 630-492-1912. More after the break.
Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 630-492-1912 or find out more at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC registered fiduciary headquartered in Oak Brook, Illinois. That said, we do work with individuals nationally, so we're going to continue to get on to other stations throughout the country simply because we love our message. We love the message that we are bringing, which is education, education, education. The markets are at all-time highs, and history has been made over and over again. We've now seen 14 straight years with at least one all-time high, which is 2 years longer than the epic 1989 to 2000 run, which was 12 straight years. So records are made to be broken, and we look at what's going on in the world today, and you look at the fear that so many people have. I don't know if it's justified. I don't know if it's warranted, because the only thing I know for a certainty is I don't know what's going to happen tomorrow in the market, and that is how we craft portfolios. The job of an advisor is for clients to still win, reduce taxes, even if the markets go down. That is the job of an advisor. And unfortunately, most advisors simply do not do that. And if they do not do it well. 630-492-1912, 630-492-1912. We'd love to welcome you into our office. We would love to walk down a true financial plan, a true tax mitigation plan. We would love to look at Roth conversions and ways to minimize those conversions by utilizing the energy strategy that has just phenomenal built-in tax advantages. We target $80,000 to $90,000 of active or passive tax benefits. So if you invest $100,000, let's just figure $85,000 is going to reduce your W-2 1099 income. We used to not talk a lot about that on the radio, but again, where we look at what our greatest competitive advantage is, if you're working with a big bank, if you're working with a big brokerage firm, there are chances that you just simply don't have tax mitigation strategies. As proactive as they are going to get is tax loss harvesting, and that is simply not proactive. Well, I can't say that. It is proactive, but it's proactive. It's being proactive at the kindergarten level. We're talking about strategies of investing in the single best oil and gas companies, the single best oil and gas field in the Permian Basin in West Texas, alongside as an owner. I mean, literally not doing the drilling, letting Exxon, Chevron, Conoco, Matador, Mewbourne do the drilling. We're just simply a minority owner in their projects. And then we get cash flow paid to us every single month based on the production. And oh, by the way, you get phenomenal tax benefits. It's a diversifier from the overall equity market. So we're going to talk an awful lot about that on the radio. So if you sold a building, if you sold a property, if you have concentrated stock positions, if you want to do a Roth conversion, but you don't want to increase the income from the conversion, we can pair that with an investment in Bison. Bison 2 is the current fund. On the return side, we target 2-to-1 return at exit, which is generally 5 years. So for every $100,000, you get your $100,000 back plus another $100,000. Now, again, that's a target, and that's a target at $60 to $65 oil. It may be hit. It may not be hit. We don't know what the price of oil is going to be. I personally believe that number to be conservative. But again, we're not in it for one fund. We're coming up on our third fund. The next fund is going to be $250 million. So we're closing out Fund 2. Have phenomenal assets. We've got another about $20 million of capacity. So we would like to, for those investors that are coming in now, you're coming into an established portfolio of cash flow already. So we can show you the assets that we own. We can show you the wells that we own. We can show you the acreage that we own. I mean, at $50 million, we'll probably have over interest in over 200 plus wells, 30 to 50 permitted wells, probably 100 plus upside wells. Hopefully we'll have well over 1,000 acres. So those that are coming in now, there's a much more clarity as far as exit than those that started when we launched the fund. And so we're very pleased with that. So 630-492-1912, 630-492-1912. I mean, there is a shocking stat. There's so many shocking stats that we see over and over again. The Dow Jones, which we don't really ever quote the Dow. Individuals do. That's all they say. The Dow. What'd the Dow do? What'd the Dow do? Most professionals are going to look at what the S&P did for obvious reasons. But the Dow has now posted 8 consecutive monthly gains. That's the longest streak since 2019. It also marks the second longest run since the 1950s. Historically, after we see these types of streaks, the index advances in 6 of the 8 cases 1 month later. So many people are still thinking that this is going to be a bad year. And you know what? It very well may be a bad year. AI may fall out of bed. AI may slow down. And when you look at what is going on in the world, you look at the fact that the S&P was up 17.9% last year. The 493 added more to the gains, which, we've always heard of the Mag 7 and what the Mag 7 was doing. But if you look at the other 493, they actually contributed 10.4%, and the Mag 7 only did 7.5%. That's the first time that we've seen that in 3 years. So when we look at what has been driving the market with these massive gains, you have to really wonder, is that going to continue? And it may and it may not. And that's one of the things that we just don't know what is going to happen in the market tomorrow. So we have to focus on what we can focus on, which is really three things. Tax reduction. How can we greatly reduce your taxable income? Number two, how can we create a financial plan that models out your tax life to age 95? And then number three, how can we craft a portfolio that has investment strategies inside the portfolio that can still deliver positive returns even if the markets are down? That to me is really our three mandates and our three strategies, our core three of what we focus on. Tax reduction. Now, tax reduction really is, part of modeling out your tax life to age 95 and looking at those RMDs. If you have a 7-figure IRA, you have no clue how big those RMDs are going to be. And you may think, well, I can't do a Roth conversion. Well, maybe the normal advisor can't do a Roth conversion because you have nothing that can offset that conversion income, but we do. We have the Bison II fund. We have the energy funds that can offset that income. And so people who have larger IRAs, who previously their advisors, have said you can't do it, it doesn't make sense. Well, yeah, the traditional advisor maybe, but not the strategy, not advisors like us that have that proprietary energy strategy. And so, yes, we want to model out those RMDs to age 95. Yes, we want to make sure that you have strategies inside your portfolio. Strategies like the bank notes, strategies that are offered by the largest banks in the world, JP Morgan, Citi, Bank of America, BMO, Morgan Stanley, UBS, etc. We're still pricing around 12%. We did $60-70 million of new issuance last year. I don't know the exact number, but I'm sure we'll get that number here soon. But if I had to guess, it'd be 60 to 70 million in new issuance in those strategies. So many people want them because, and again, they're not even cutting edge. They're cutting edge in the early 2000s. It's just that most advisors don't understand them. They're very, very labor intensive, and so they have no interest in utilizing them, and so they don't, right? Well, we do. We grew up in the industry utilizing those, so the extra work that it entails, we're okay with that because it's brought in so much money to the firm, and it has helped out clients so much. So when you can look at a client and we say, again, one of the biggest problems with the average portfolio advisor, average financial advisor rather, is they cannot articulate to the investor, if you ask them, what do I have in my portfolio that will not go down or will still make money when the markets are up? They can't answer that question. They'll start talking about time. They'll start talking about diversification, blah, blah, blah. I mean, again, just think about it. If you bought Microsoft in 2000, it took you 14 years to get back to even. 14 years to get back to even. 14 years to get back to even. And that is an issue. That is an issue. Do I think that that's going to happen again? Yes. Do I think that it's going to happen again? No. I don't know. Nobody knows. So what I do know is that we have to craft portfolios that can still do well even in those markets. And the bank notes, very, very, I can't tell you how many people love them. The bank notes are still pricing around 12%, some maybe a little higher, some a little less, but around 12%. And you get that paid to you. That's an annual number paid to you monthly in cash flow every single month, as long as those indexes are not down 30%. So you have 30% downside before you don't get paid a coupon payment in that month. Compare that to any other cash flow strategy out there. And that's a big chunk of our money. It could be 10%, it could be 50% of someone's portfolio. But when our clients are asked, if you came up to our client and asked, how do you make money if the markets are down? Well, that is the easiest, most simplistic strategy out there. 630-492-1912, 630-492-1912. I hope we do $100 million in those strategies this year. So If you don't have them, you need them. You need to at least have a conversation. Number two, we talk a lot about annuities, right? A lot about annuities and lifetime income annuities. I've yet to find, based on inflation, based on lack of growth, don't ever buy an annuity based upon the illustration. The illustration is not actual performance. It is hypothetical back-tested performance. If you are getting sold one, call my office, 630-492-1912, and show me the illustration, and we'll show you what the real performance of those indexes are, and I guarantee you it's a lot different. But here is one of our strategies that we love, 5-year index annuity. So simple, tied to the S&P. Your worst year is 0. You're currently capped on the upside at 10 3/4. Anybody can understand that strategy. Those are the two strategies that we use for down markets. So we're going to get back to our growth side here after the break, but give us a call, 630-492-1912, 630-492-1912. More after the break.
Wake up, brush your teeth, get dressed, get the kids out the door, drive to the office, and realize you don't even know how you got there. Seems like while we're working, we're operating on autopilot. And while that might be okay when it comes to the 9 to 5, autopilot won't cut it for your portfolio. Your portfolio needs to pay you, continue to grow, and be as tax and fee efficient as possible. And that's where Robert Kuhn and Kuhn Capital Partners can help you. Meeting with Robert and his team at Kuhn Capital Partners is a good start to living the retirement you want to live. To set up a visit and get on the calendar with Robert Kuhn, call 630-492-1912. That's 630-492-1912 and talk with Robert about the things you've heard on today's show. You can also find out more about what Kuhn Capital Partners can do to help you with your retirement online at KuhnCP.com. That's KUHNCP.com. You're listening to Destination Retirement with Robert Kuhn. Still to come on today's show.
So we want to make sure that we can win in down markets, and we have strategies that can win depending upon your definition of winning in a down market. So 630-492-1912, 630-492-1912. On the growth side, just absolutely kicking butt. We rolled out soft launch our hedge fund fourth quarter. It's called Bison Alpha. And basically it's our philosophy of utilizing AI and event-driven strategies. We think it's the most cutting-edge use of AI when it comes to active management, and there's significant money to be made.
That and more still to come on Destination Retirement with Robert Kuhn. Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give them a call at 630-492-1912 or find out more at KuhnCP.com.
You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. I lead the firm. I'm in charge of strategic development. I'm in charge of growth. I'm in charge of what we're bringing to the table for our clients, for those that want to work with somebody that's unique, that's somebody that's different, that's somebody that is incorporating strategies that advisors actually invest their own money in. Think about that. I've talked to you a lot about it. There's a very, very good chance that the advisors that you're currently working with are not utilizing the investment strategies that they are sharing with you. Why is that? Well, they're scalable for them to raise more money, make more money for them, but they have very little risk management in place. And we look at, is the 60-40 portfolio dead? That was kind of, the added 60-40 portfolio, which is just mind-boggling to me that you would work with an advisor and have a 60-40 portfolio. Why are you paying his fees, her fees? Why? If that's what you want, albeit I don't think that's the best way to compound money and really grow portfolios, just go to Fidelity, just go to Schwab and tell them to do it. They'll do it for you. You do not need an advisor to do that. Total return for 60/40 portfolio in 2022 was down 16%. Strong year in 23. I guess strong is relative, right? Not compared to the S&P, but 18, 2024, 15, 2025, 13. And that is okay. Certainly nothing wrong with that, but you're just diluting ultimately your returns, in our opinion. You look at the bond market. The bond market had a decent year last year. The last 5 years, it's been in the worst drawdown in history. And if there's one thing that I think is going to continue to be a issue for individuals is inflation. And again, that's why I will never stop harping on those lifetime income annuities. I just can't, because the fixed payment that you're going to get for life is just going to get eaten up by inflation. And that's why the bank notes that we are so well known for, and they're still pricing, 12% with 30% downside protection. And if you look for cash flow, 12% annualized currently, and maybe a little more, maybe a little less with volatility, they'll spike back up to 13 or 14. There are chances that, we can see it slightly under 12. But you get that monthly payment as long as those indexes are not down 30%. So think about if you just did that with the S&P, what that number would be. And it just takes a little education. It takes a little education. And that's what we're here to do. 630-492-1912. 630-492-1912. I love it. I love the fact that, we probably have 4 to 5 call-ins a week. The average listener generally will say, I've been listening to you for 2-3 years. We're ready. And that's phenomenal. And we love those clients. And we also like the clients that heard me one time and I say something that's unique and they want to talk. But again, we're here for you. We're here to educate you. We're here to make sure that if the markets do drop significantly, that you still can win with some of your money. And I know I finished up quickly the 5-year index annuity. That does pay a commission. It absolutely pays a commission. I can't remember exactly what the commission is, around 5%. They say that you don't pay it because it doesn't come out of your pocket. If you put in $100,000 goes to work for you. I don't know if that's, it's a factual statement, I guess, but somehow you're always paying it, but they do pay a commission. But that is one of the best strategies that we have for down market protection. And it's very short term in 5 years. It's very simplistic to understand. It's tied to the price movement of the S&P 500. So you don't get the dividends. It's the price movement of the S&P 500. Each year, not a calendar year, but a year you buy it, 1 year from that day, they simply look at the S&P, and if the index is negative, your return is zero. Literally that simple. It could be down 10, could be down 100, your return is zero. And then you get a cap on the upside, and that current cap is 10 3/4. Now that can change, okay, but that's the current cap, 10 3/4. So you get from 0 to 10 3/4 of the growth of the S&P, not including dividends. So if the S&P is up 15, you're going to be capped out at 10 3/4. Now again, we're not trying to get equity-like returns out of these strategies. We have other monies that are going to get equity-like returns. This is a bond replacement. This is a fixed income replacement. In any year you get a gain, that gain is locked in. You never see that gain go backwards. And so I bet you if these were fee-based, I think last year in the annuity space, it was something ridiculous, $500 billion or something like that. There are so many advisors that don't do them because they pay a commission, because they want that fee. Well, what I want, what's good for me, what's good for my firm, what's good for my family has zero relevance, or you shouldn't even care about it. It has zero relevance on the plan that we're making for you. Would I rather get a fee? Of course. I would rather have a 1% fee. I don't need the 5% up front. I don't want it. I would much rather a fee, but I cannot make an investment decision based on how we are compensated. So many people think the market's high. Many people think there's a crash coming. I don't necessarily agree with that, but it could happen because my gut, your gut, it just doesn't matter really what our guts feel. But if you're really nervous, then take some safe money, put it in the 5-year bucket in the index annuity that's tied to the S&P. I would never do an annuity that is not tied to the S&P only. Now, we have done a couple in the past because that weren't tied to the S&P, because the S&P with those strategies was not competitive. Those were little unique one-off cases, but we will only do, for the most part, strategies that are tied to the S&P, because these flashy indexes that on paper they show you did so well, they really didn't do well because they're only 2 to 3 years old and the returns are negative. So these volatility control indexes have absolutely killed the lifetime income annuity story. So, but yeah, 5-year tied to the S&P, zero downside. Your worst year, zero, you get a gain, it's locked in. So when you combine that with the bank notes, well, right there, if that's 25 to 30% or 40% of your portfolio, we've got a way to make double digits with maximum downside protection. That's what the current advisors that you're probably working with are not bringing to the table. They're just simply telling you, don't worry about it, time in the market, blah, blah, blah. Okay. Nobody debates that the markets go up over time. What time are we talking about, right? I can show you periods of 14 years that if you bought at the wrong time, which is a high, it took you 14 years to get back to even if you just bought Microsoft. The S&P, almost 10. So we want to make sure that we can win in down markets. And we have strategies that can win depending upon your definition of winning in a down market. So 630-492-1912, 630-492-1912. On the growth side, just absolutely kicking butt. We rolled out soft launch our hedge fund fourth quarter. It's called Bison Alpha. And basically it's our philosophy of utilizing AI and event-driven strategies. We think it's the most cutting-edge use of AI when it comes to active management. And there's significant money to be made. And when you can utilize AI in a scalable way, we can run significant dollars in that portfolio. Now, again, 2.1 net worth to get into it. Doesn't have to be investable. It just has to be net worth. And that cannot include your primary residence. Again, not my issue. I didn't have that requirement. I think the requirement is dated, but we have to live with the SEC's rules, and those are the rules of the road, and so we abide by them. But funds audited, and it's just a way to incorporate AI, incorporate event-driven strategies to try to make asymmetric returns when the events happen. And really the way I look at it is it's how we run. It's basically our philosophy of running our own money that we've now created a fund so we can do it at scale. And again, that's Bison Alpha. So if you have any interest in that, you're going to hear a whole lot more about that on the radio again this year as well. 630-492-1912, 630-492-1912. And on our core growth strategy, phenomenal third-party money manager that we utilize. Historically, even though past performance is not indicative of future results, we have to understand that their performance has been significantly net of fees out, much greater than the S&P, 1.5, let's call it 1 to 2% a year on average. Doesn't seem like a lot, but when have been running money, the PhDs since 1995. You're looking at a cumulative outperformance of the S&P of almost 1,400%. Again, quantitative, mathematical. This is, I can't stand individuals working with advisors that are using index funds, ETFs. You don't need them. Why pay their fee? Go to Schwab, go to Fidelity. Those guys are just as credentialed. They can run just as fancy as a financial plan. You have to have active management because anything more than 25 stocks, you dilute the return. So when you look at what we're doing, we just talked about the index annuity in our protected growth bucket. We talked about the bank notes that are still paying, north of 12 or around 12 at 30% downside. On our growth sleeve, we've got our third-party money manager that is quantitative in nature, that ranks in the top 3%, top 7%, respectively, of each of their models, at least currently. And then you have our opportunistic growth, which is the Bison Alpha Hedge Fund. That is, I roll my management fees of the fund currently into the fund. So we're right alongside of you as far as investing. And then you have the private equity alternative tax reduction side. And so hopefully you can start to see how we have a competitive advantage, how we have a moat that is very hard for other advisory firms to bring to the table. So if we can help you, if we can talk with you, if you want to have a conversation, a review, 630-492-1912, 630-492-1912. More after the break.
Wake up, brush your teeth, get dressed, get the kids out the door, drive to the office, and realize you don't even know how you got there. Seems like while we're working, we're operating on autopilot. And while that might be okay when it comes to the 9 to 5, autopilot won't cut it for your portfolio. Your portfolio needs to pay you, continue to grow, and be as tax and fee efficient as possible. And that's where Robert Kuhn and Kuhn Capital Partners can help you. Meeting with Robert and his team at Kuhn Capital Partners is a good start to living the retirement you want to live. To set up a visit and get on the calendar with Robert Kuhn, call 630-492-1912. That's 630-492-1912 and talk with Robert about the things you've heard on today's show. You can also find out more about what Kuhn Capital Partners can do to help you with your retirement online at KuhnCP.com. That's KUHNCP.com. Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 630-492-1912 or find out more at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. We have not counted every one of our episodes, but we decided that we're probably around 250. So this is episode 251. And so that's what we're going with, episode 251. And I'm also the host of this radio show. We entitled it Destination Retirement. And I am also the president and founder of Kuhn Capital Partners. We are located in Oak Brook, Illinois, right across from the Oak Brook Mall, right off 22nd Street. And if you Google the Fidelity office, we're on the 5th floor. They're on the 1st floor. We'd love to see you. Stop in, Suite 530. No appointment needed. You just may have to wait a few minutes if we're with a client, which there's a good chance that we will be, but grab coffee and just sit and enjoy some peace and quiet, and we will certainly meet with you when we can. So 630-492-1912, 630-492-1912. This show is changing. This show is going to be much more, I don't want to say hard-hitting, but much more matter of fact. We want to pull the curtain back of asset management because, unfortunately, most advisors are doing nothing more than creating closet index funds and dressing it up as proprietary, selling lifetime income annuities without explaining to the investors what could happen with high inflation and what could happen with the cash flow and the purchasing power of those annuities. And we think there's just a better way. And our way that we look at it is protected growth, opportunistic growth, and then tax reduction. The most overlooked area, in my opinion, of financial planning is tax reduction. We have a lot of potential headwinds that the market may face. When you look at the current market, PE ratios, price to earnings is relatively high. Anything 23 or higher, which we're currently, depending upon what day, in the 24 to 25% range. In every case, the 10-year return, the forward 10-year return, the range was between -2 and +2. So think about that. PE ratios, 24 to 25. The forward 10-year return has always been between -2 and +2. Now, does that mean that's going to happen? I have no clue. I mean, things are meant to be broken, right? It's different this time. Those are the four most expensive words in investing. Maybe it won't happen again. But if we use history as a gauge, we have to go into the next 10 years thinking low returns, thinking drastically lower returns. Now, that doesn't mean that that's going to happen. Okay, as they say, past performance is not indicative of future results. Anything I talk about on the performance side, I don't know if it can be repeated or if it can't be repeated. Now, we believe in AI for our hedge fund. We believe in event-driven strategies for the hedge fund. We believe in our growth strategy, the quant strategy, the manager that we use. It's quantitative, it's mathematics. I think those strategies are more repeatable than gut feel. So I'm at least okay looking at, historical performance and using that as a gauge going forward. But again, nobody knows what's going to happen. But if you look at where the market's expensive, and throughout history at these prices, the next 10 years has always been -2 to +2. And if your portfolio can't handle that, or if you don't know if your portfolio can handle that, then we need to talk. 630-492-1912, 630-492-1912. Love to just, have 2 to 3 meetings of new potential investors a day. That is our job. That is our goal. That allows us to help you put your mind at ease. And when you look at, being able to remove a lot of the downside risk of the market while we believe not foregoing any of the upside, because again, several of our strategies are on the opportunistic growth side. If you have let's just look at our protected strategies, right? We call them protected growth, whatever. Protected growth strategies, it's the 5-year index annuity that has zero downside. Currently, albeit it can change, but currently 10 3/4 of the S&P 500. Now you don't get those dividends. So it's just simply the price movement of the S&P. There's a lot of people out there that would love if they could trade off for a 5-year period. So you're close to retirement, just retired, whatever. You need a pool of money in 5 years. You don't want it to sit in CDs. You don't want it to sit in bonds. You don't want it to sit in cash. You want to give it the opportunity to grow. Well, there's a phenomenal strategy for you. Your worst year is 0. Okay, not backed by the government. It's obviously backed by the insurance company, but it's a 5-year commitment. And any year, not a calendar year, it's the year you buy it. So if you bought it today, they look at it, 12 months from today. If the S&P is negative, your return is 0. It doesn't matter how negative the S&P is, 1% or 100%, your return is 0. There's obviously some give and take there. So you're giving up the fact that you could lose money. Well, you have to have a cap on the upside. And again, it's all option and zero coupon bond pricing. So we can get into how the watch is made, but probably put you to sleep on the radio show. But the current cap, which again can change, is 10 3/4. So you get the first 10 3/4 of what the S&P 500 does, excluding dividends. There are so many people that if you could look them in the eye and say, hey, this pot of money is whatever. It's our safe money. It's this, it's that. And I can invest and have it tied to the S&P. 0 downside. Get it capped out at 10 3/4, which it currently is. And never give back that gain. If we get a gain, that's it. That the downside is 2 things. 5-year commitment. You can always get out, but you pay a surrender charge. 5-year commitment. And you're capped at 10 3/4. So you can't get anything more than that. And that 10 3/4 can change. Sometimes it changes greatly. Used to change greatly. We don't see them change that much anymore. Those are kind of the old days. But that 10 3/4 is variable each year. And it may go up, may go down slightly, but they try to keep it right around there. It's just best practice for the insurance company. That is a phenomenal strategy. And you pair that with the banknotes where you can get double-digit returns as long as the indexes are not down 30%. I mean, that strategy alone, though, the banknotes, number one, have brought in more money to my firm over the last 12 months than I didn't think it was possible, just because people aren't advisors are not educating clients on what is out there. I mean, the banknote, we call it banknote because it's a very generalized term. Every bank has a little different name, but they all work the same, at least the ones that we do. At date of issue, they lock in 3 indexes. We use the S&P, the Russell, and the KRE, and then for some other ones, we use the S&P, the Russell, and the Dow. So we merge 2 together. And as long as those indexes each month from the date of issue aren't down 30%, if your note pays 12% annualized, you get 1% a month. I mean, it literally is that simple. So there's a strategy that if the markets are negative, that you're still making money. And you can look at it and know beforehand what is going on. And then you look at what's going on in our advanced growth, our opportunistic strategy with our hedge fund that we're so excited about. We want to get that to 100 million by the end of 2026. So if you're tired of just buy and hold, if you want to be able to have a mathematical AI-based strategy that can go against the market, that can go with the market, that doesn't have here's the objective. We don't care about being right. We just want to make money. Don't care about being right. We just want to make money. And the computers can greatly enhance that probability. So Bison Alpha is that. 630-492-1912. 630-492-1912. We would love to go over that with you. And then obviously on the tax strategy, that's, most of you already know about that. But our energy strategy is phenomenal. The tax benefits just come with it. But how many advisors can tell you that a strategy comes with tax benefits that if you invest $100,000, we target $80,000 to $90,000 of tax benefits that can offset active income, passive income, 1099, W-2 income. So high wage earners, physicians, business owners, individuals that are selling properties, have a liquidity event in a company, have concentrated stock, and it is very low correlation to the S&P, and we target 15% annualized cash flow while we're waiting to exit those strategies by just simply investing alongside of the majors in their projects, the Exxon, Chevrons, Conocos of the world, and the number one oil field in the world, the Permian Basin, again, on the custodial platform of Charles Schwab. So if you have a Charles Schwab account, you'll see that line item on your statement. We custody all of our clients, or the bulk of our clients' money, at Charles Schwab. So you see it on your statement. And all of a sudden, we are bringing to you something that is very hard to replicate, very, very hard to replicate. And we're very proud of that. And we're going to scream it from the rooftops because we are passionate about helping you. We are passionate about helping you not lose money. We're passionate about helping you minimize your taxes. We're passionate about you making as much money as possible for some of the portfolio. And the 60-40 models, I mean, those are just lazy advisors. The advisors selling lifetime income annuities, those are the lazy advisors, in our opinion. And you just need and owe it to yourself to get with a cutting edge firm. And that's what we're doing. And the amount of clients that we work with proves that. The caliber of clients that we work with prove that. And we just want to help you. So if we can do that, please have an initial call, have an initial meeting. Let's get a financial plan complimentary for you. Let's look at your tax analysis. Let's talk about ways to greatly reduce your taxable income. Let's talk about ways that your advisor said you can't do Roth conversions because you're going to get too much income from the conversions. Well, let's pair that with an energy strategy that can reduce that. So many things that we can do. And episode 251 is complete. Hopefully you got something out of it. We would certainly love to have the opportunity to talk to you. You can start the conversation by calling 630-492-1912, 630-492-1912. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.